The headline flashes across market terminals worldwide. In historic Senate hearing, CME exec admits fractional silver inventory. At the epicenter, Marcus Webb sits under the stern gaze of U.S. senators and global media. His admission chillingly simple. COMEX inventory isn't 1.1. Less than 11% could ever be physically delivered. The executive order drops with little warning, launching federal inspectors into the labyrinthine vaults of New York and London. The audit's findings ripple through the financial sector like a seismic wave. Stacked bars of silver sorely missing, reports inflated, and an $18 billion chasm opening beneath the world's largest metals exchange. Within hours, breaking news banners announce the shortfall, and trust in the system evaporates. Futures trading screens are chaos. COMEX silver opens limit up. Within minutes, all contracts are halted as circuit breakers trip. Traders with open positions jab furiously at phones, desperate for answers. On social media, screenshots circulate. Leading bullion dealers have suspended all new sales, or are quoting unprecedented 15 per ounce premiums above spot for physical coins and bars. For most, there simply is no inventory. Global echo. In Tokyo, London, Zurich, and Shanghai, silver futures spike and freeze one after another. Arbitrage is impossible. Panic is contagious. Major industrial users, solar panel manufacturers, smartphone giants, defense contractors scramble to renegotiate contracts and buy any physical silver available. Warehouse managers field calls for quantities they never expected to sell. Suppliers run out in hours. In boardrooms across the globe, emergency meetings convene. Production lines depend on silver, and there is no substitute. The phone lines of Wall Street's largest bullion banks glow red. Their short positions, once a source of steady profit, are now a ticking time bomb. Risk officers model catastrophic losses, while compliance teams comb through legal clauses about force majeure. In the background, compliance officers field subpoenas. Class action filings mount from pension funds, hedge funds, and corporate treasurers caught holding what's now termed worthless paper silver. The government's press conference is terse. There is no simple money solution to a physical scarcity. Higher prices will ration supply. They announce a working group, but the market sees this as little more than political theater. The main regulatory options, order compulsory cash settlement, and suspend physical delivery across ETFs and futures products, send a further chill through investors. Headlines declare, "Paper silver market effectively dead." On the shop floor of a leading solar panel company, the realities bite. Production slows to a crawl as engineers scavenge for silver contacts, delaying shipments for the first time in years. Procurement chiefs turn to the gray market and small refiners, but prices are up 200% overnight. In a defense electronics lab, technical managers nervously brief generals on the likelihood of component shortages for key communications hardware. Silver investors, many holding ETF shares or unallocated accounts, field margin calls, their positions force liquidated into cash at a fraction of the metal's new physical value. The legal wrangling begins. What did they really own? Only those with home-delivered coins or private vaulting walk away whole, now sitting atop what is rapidly becoming the world's hottest asset. Conclusion. The episode closes with hard lessons written across financial headlines. Markets cannot conjure physical commodities by decree. Trust, once broken, is costly to repair. And governments, however powerful, cannot bend material shortages to their will. The once sleepy silver market, now the epicenter of a modern economic earthquake, writes the final chapter of paper promises undone by the scarcity of the real thing.